Welcome to the deep dive. We're here to really get into the skin of complex topics. Today, it's Vingroup, that absolutely massive Vietnamese conglomerate. I mean, its impact on Vietnam's GDP alone is staggering, almost 1.1% back in 2022. We've got a stack of analyses here looking at their debt-to-asset ratio from, 2020 right through to the first quarter of 2025. And our job today, to unpack what this ratio really tells us about a company this huge, this diverse. And honestly, there are some surprises in here.
Yeah, definitely. And maybe just to start, the debt to asset ratio, it's pretty fundamental, right? It tells you how much of a company's stuff, its assets, is paid for with debt. Higher ratio usually means higher risk. But, and this is key for Vingroup, you've got this giant company in really capital-hungry sectors, real estate, cars. So you need a bit more nuance. It's not just high equals bad here.
Right. Context is everything. So diving into the data then, what's the first thing that, jumps out about Vingroup's data? Because something felt a bit counterintuitive to me.
Well, yeah, it's this. Despite all the expansion, all the growth, their debt-to-asset ratio has been remarkably stable, like consistently between about 27% and 32% over this whole period. And think about the growth assets shot up nearly 80%. We're talking almost $33 billion by the end of 2024. And total debt kept pace up about 75% to $9.83 billion by March 2025. Keeping that ratio steady with that kind of growth, that suggests some very deliberate financial management. Or maybe specific risks.
That stability is really striking given the sheer scale. Okay, but here's where my head started spinning a bit. Our sources make this really important distinction, right? Between total debt, that's the interest-bearing stuff, the $9.83 billion you mentioned, and then total liabilities, which was way higher. What was it? $30.784 billion in Q2 2025? That's a massive gap. What's going on there?
Exactly. And that difference is, it's fascinating. A huge chunk of it comes from liabilities that don't bear interest.
Yeah.
I think mainly customer advances.
Yeah.
People paying upfront for apartments in Vingroup's real estate projects, for example.
So pre-sales essentially, like crowdfunding their construction almost.
Kind of, yeah. It's a pretty cheap way to get funding because you're not paying interest on those deposits, right? But it swaps interest rate risk for other kinds of risks. Liquidity risks tied to actually finishing the projects, keeping the buyers happy and confident.
Right. So less interest cost, but you're totally reliant on delivering those apartments and keeping the market sentiment positive, a different kind of pressure.
Precisely. It shifts the risk profile. It's dependency on future performance and customer trust.
Okay, understanding that non-interest liability piece is crucial. But even with that, the sheer amount of capital needed is just enormous. So what's the main driver? Where's all this money going?
Well, the sources all seem to point one way. VinFast. They're a really ambitious car company. I mean, just imagine pouring billions into one venture. Billions! And then seeing losses like $3.178 billion in 2024 alone, with negative gross margins. That's wow. It's a huge gamble. And what's also quite extraordinary is the level of support VinFast gets from the mothership, from Vingroup, and from the founder himself, Pham Nhat Vuong. We're talking about $13.5 billion in loans and grants already provided, plus another $3.5 billion pledged, and Mr. Vuong personally pledging nearly $2 billion of his own money by the end of 2026. That's not your typical corporate subsidiary funding model. It shows how vital VinFast is to their strategy.
Almost like an at-all-costs kind of commitment. But VinFast isn't the only factor, is it? There are other moving parts. Like they sold off Income Retail, right? That brought in, around $835 million? Needed cash, I assume. And then there's the wider Vietnamese economy. A bit of a slowdown in real estate. Those NPLs, non-performing loans, hitting 3.7%. Plus, borrowing got more expensive. Vingroup issued bonds at 12.5%.
Yeah. Absolutely. Those are all part of the picture. But if we step back and compare, Vingroup's overall debt-to-asset ratio, around 30%, it actually sits okay compared to the Vietnamese real estate average, maybe even slightly below it. That average is somewhere between 28% and 34%. And it's way lower than retail companies in Vietnam, which are up near 50%, or a standalone car company, which would easily be 60% or more.
So the diversification helps mask the strain from VinFast on the consolidated balance sheet.
It helps balance it, yeah. That's the benefit of being a conglomerate.
Yeah.
But the risks doesn't disappear. That's the core issue, really. Despite the stable ratio, VinFast's heavy losses are a drain. And it affects how investors see the whole group. You even see profitable parts, like their real estate arm, VinHomes, getting speculative grade ratings from credit agencies. Why? Because everything's so interconnected. The risk from VinFast casts a shadow.
Okay, so let's try and wrap this up for you, the listener. What we've seen is Vingroup showing this stable debt-to-asset ratio on the surface. But underneath, That stability is heavily shaped by, well, the massive ongoing investment in the loss-making VinFast, by the huge financial lifelines from the parent company and founder. In this unique way, they fund real estate using customer money. So here's the thought to leave you with. When a company's key financial ratio looks steady, looks okay on paper, but it depends so much on one very risky venture and the personal backing of its founder, what does that really signal about its true long-term strength? Is that stable number always a sign of health? Or does it sometimes hide deeper strategies, bigger risks that you really need to keep digging to understand? Something to think about next time you see those headline financial figures.